a rising interest rate isn't a reason to stop. It's just be aware of what's happening. And from a global supply chain, I do have the pleasure of working in a global environment. It's a great opportunity to see what's going on all over the world, and things are moving. Even though in some cases it's a little bit slower or more expensive, but they're still moving and things are opening up. I think we can all see that. I'm 100% bullish. I'm actually bullish on a specific niche of real estate, but real estate transactions are taking place every single day. So I'm very much bullish.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 354. If you've been paying attention to the news and the economy, then you know that one of the causes of our high inflation rate has to do with supply chain and global logistic challenges. But what does the supply chain have to do with real estate investing? And should investors be more cautious? My guest today is Jeff Davis, who solves complex supply chain issues for clients all over the globe. He's also the managing partner of Bridgestone Capital, a private equity firm that has partnered on over $100 million worth of multifamily investments. Jeff, welcome to the show.
Thank you so much, Brian. And I really appreciate the opportunity to be on your show and speak to some of these issues.
Ground us first in just the context of like both who you are as someone who understands the supply chain globally, and then also who you are as an investor in your own right.
Born and raised in New Orleans, and we came over here, my wife and I, in 2005 to Houston, Texas, after Hurricane Katrina. At that point, I began knocking on doors to look for a job, and that's how I got into the logistics world. A company was kind enough to give me a job doing data entry, and that's where I learned about logistics, basically just dispatching trucks and offering customer service. I really enjoyed solving some problems for customers in terms of how to find their cargo and get it from one place to another in a timely fashion. Really built relationships. Everything's about relationships, and learned how to get their product from the U.S. to another project around the world in a timely fashion, or meet some deadlines here in the U.S. over the next 15 to 20 years. And that's what I do now. I have customers all over the world, and the supply chain around the globe is a very fragile and complex thing. And that's what I've been doing in my almost 2-decade career.
Bring us up to speed on your real estate investing, because you are an investor. You have over like $100 million deployed through your company. Why don't you tell us about that as well?
I began investing in rentals back in 2015, and that was really just to stabilize my income. I was in a sales role and wanted to begin getting some stability in my income. Right, sales is a volatile thing, and our economy is volatile. It always has ups and downs. And the one way that I saw to stabilize that and have my commission checks start earning commissions was to put it into real estate and have an additional income stream in the form of rental checks. And so over the next 5-10 years, I really I was able to scale that up. And so now I've partnered on quite a few multifamily properties, and that's how I've scaled that up. And we've got about 1,400 units now, from single family into multifamily.
So let's talk about the supply chain problem, especially as it relates to real estate. For those who haven't been paying attention to the economy and the news, bring us up to speed on what is going on with the supply. What is the supply chain and what's going on with it right now?
The supply chain is everything that we touch. right? Whether it's a soda can or it's a computer and laptop, or whether it's your automobile, everything's comprised of different parts that are purchased from any number of manufacturers, from the US to India to China and Malaysia, even parts of Europe. And so companies, conglomerations have suppliers all over the world. And that's where they get different parts and put them and combine them and bring them to consumers all over the world. And so it's a very complex consortment of things. It is not just a click of a button on your iPhone when you're ordering to have a part here, or an item delivered to your house from the Amazon driver. There's a much more complex system behind the scenes.
And what is going on with that system right now that's driving inflation?
Well, the large bulk of items that are brought around the world are moved on ocean vessels, container ships. And so when you've got 80 to 90% of goods that are moved on container ships, any, for lack of a better term, cog in the wheel that disrupts that will cause delays. And so we've had a number of black swan events in the past 2 years, the main one being COVID-19. So when COVID-19 happened, you had US shutdown as well as a European shutdown and Asia shutdown. However, demand did not shut down. And so while US spending did not stop, it just diverted to US goods as opposed to US services. So we could not travel, we could not go out to eat, and we could buy goods, right? So everybody stayed at home and purchased their goods from a laptop. And they also were able to go to their home goods stores to do more planting and gardening and home improvements. So the demand for consumer goods was driven up tenfold, and the large majority of those goods are coming from Asia Pacific, which meant all of those ocean containers were driven up. The demand for those containers were driven up. At the same time, the traffic, or rather the labor that's required to offload those containers at US ports, was not available. And so you've had this unique situation where nobody was there to offload containers. The demand was unreasonably high. And this went on for, as you know, almost a year.
We're recording this right now, mid to late September 2022. Where are we right now in that problem? Is it still a problem? Is it still happening? And how much longer do you think this is going to go on?
It is not still a problem. I want to say that with caution. It's a different problem now. It's really working itself out, right? And so I'll backtrack just a little bit. What that caused was an extreme price inflation on the cost of shipping. The cost of a container from China to LA historically is between $1,500 and $2,200. That price skyrocketed to up to $25,000. So if you are an importer, if you're a business who has a shipping budget of $100,000 on a normal year, your shipping budget just went to about $1 million. And so it took some time to transfer that cost, that new cost, unexpected, unbudgeted, down to their customers who may have been industrial, and then those industrial customers to the consumer. And that transfer of cost just hit the consumer in Q2 of this year. And that is a major cause of inflation, in addition to increased labor costs overseas, and in addition to increased lead times, right? So we had a period of time where we could not get goods and services over here, right? We were going to the store and goods and paying more for goods that were not here. So all of that has worked itself through the distribution channel, and now inventories are completely full. But consumers are now feeling that increase in price, and it's no fun. So it's now here. The goods are here. It's a higher cost. Nobody likes it. Demand is now lower. And so it's working itself through. There's some new challenges with supply chain and with the logistics side of things. It's more on the export side because of this reduced demand. But by and large, we're on the downside of it, and some normalization is at the end of. We can see the light at the end of the tunnel.
What does this mean to real estate, and especially real estate investors listening to this show?
For myself, doing some rehabs last year, I definitely caught the brunt of increased prices, right? I mean, wood went crazy. And if you were trying to do a large scale renovation, right, a multifamily, you could not find lighting fixtures or plumbing fixtures, or those prices were double. Anybody doing any sort of renovation was really at a crux because they could not get any sort of fixed pricing from their contractors. Well, that's all leveling off. And probably we're going to be looking at some very good Black Friday sales. Is what I'm telling folks, right? Inventories are very full because these big box retailers really panic buyed, and they panic bought filling their warehouses. So look forward to Black Friday. We should see some good sales. But for a real estate investor, look out for interest rates. The Fed is not taking any chances with this inflation, but they're also not looking at, what's happening with the shipping, with overseas labor. They are looking at current inflation, which means they look 3 months back. They're looking at everything that's happening in August, and they're looking at July and June. So they look backwards. They're not looking forwards. They are ticking up interest rates. So until that goes down, we got to look at interest rates. But as a real estate investor, supplies are there. Those costs should be going down, and we can bank on that inventory being there and available.
You bring up interest rates. Where does that fit into the equation then? Is that going to help or hurt the supply chain issue and challenges? And how should real estate investors accommodate for that?
I believe interest rates are going to help supply chain issues because it's going to reduce demand overall. The less that people are buying, the less demand. So it's going to slow down that import side of things, and also could reduce some capital projects for the exports. That being said, the lower cost of oil is going to expedite some exports. So that'll increase the export demand. So it's kind of an inverse relationship there. Higher interest rates are going to probably reduce although we haven't seen it lately, should help reduce overall costing on housing. What we are seeing here in Houston, I don't know about you in Michigan, is just a longer days on market, not so much of a reduction in price. I'd be very curious what you're seeing in Michigan.
I think it's very similar. We're in West Michigan, which has a very strong housing market. And it's the same thing, longer time on market, have not started seeing the reduction in price that you would expect at this point. But, it's mid to late September. So we'll see. And I know that tomorrow, I believe the Fed is looking at raising the interest rates, and they could go another full point. So, maybe at that point, you might start seeing some of the reduction in price.
You thinking it's not today? Because I thought it was today.
I thought it was tomorrow, but maybe that's because I read an article that said tomorrow, but I read that yesterday.
So I'm banking on 0.75.
As a real estate investor, how does that higher interest rate affect us both in the positive and the negative?
No, it shouldn't matter, right? I mean, people are buying real estate regardless of the interest rate, right? There's always transactions. So no, it shouldn't matter. It's just, does it cash flow? And is what's going to happen? What's your exit strategy? Is it a buy and hold? Is it a buy and hold forever, generational? And does it cash flow, or will it cash flow? That's my take. What is your opinion?
My opinion is that if you've been doing this for a while, yes, you have to kind of look at the overall picture, but it should not stop you from moving forward. Like, in other words, don't be paralyzed because interest rates are going up. We knew this was going to happen. It's just kind of a new reality that we have to account for in other ways, which could be increased rents.
Yeah, I mean, I bought my first house in 2006 and our interest rate was, I think, 6.75.
I was paying 7% on my first investment properties.
Right. And so and then when it went down is when we really saw a big profit, right? Because as they go lower, the prices will go higher and that's when you could sell. It's not a strategy, but it is a fact. So buy for the cash flow if it can, but it doesn't slow down. It's just if the deal works.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com.
Back to the supply chain issues. Are we going to go back to pricing that we saw pre-COVID, or are higher prices now the new reality?
This is one of my bold predictions, and I'm an outlier on this because it is my prediction that we see pre-COVID levels by November. And I started stating this back in July, so I'm running out of timetable, but I'm still going to hold to my prediction. And my logic here is in May, the China to Houston, which obviously I have a lot of Houston-based clients. In May, we were still at that $25,000 to $28,000 a container level. In June, there was a 15 or a 50% drop, which is this is massive. It has been dropping ever since to that today's container rate from Shanghai to Houston is below $8,000. It is not a far cry that in the next 2 to 3 months, we could be at 5,000 or below on the average container, which would put us at or around pre-COVID levels.
So you're putting a lot of emphasis on the container rate for shipping and how that it really correlates to the inflation that we've been seeing. And then I guess it would be deflation that you're predicting?
I wouldn't call it deflation, but it is such an indicator of for retailers and for where we are as consumers and what a price level set is going to be and setting demand 9 months and 12 months out. You know, when we started seeing these prices on our side of the business, which is very much pre-consumer level, we knew back in 2021, seeing container prices at $25,000 and $30,000, that this was either not sustainable or consumers were going to feel a very painful reality. And, you know, this is only 6 to 7 months into it that we're talking about inflation. These prices of containers were a year to a year and 3 months that companies were sustaining this. So if it's only been reducing for 3 months now, then by 6 to 12 months from now, we should be back to a normal consumer price. I don't want to call it index, but where everybody's normalized. It is a real, just normal factor where we can see this is the demand and this is the normal operation of things because companies are used to paying this. This is our normal budget, right? This is our normal trajectory. When things get out of whack, we can kind of see what's going to happen a year from now.
What are some of your other bold predictions when it comes to the supply chain issue?
That's my boldest. We get back to pre-COVID. The other bold prediction is that inflation goes away without the Fed. It was going to go away by 6 to 9 months from June. So by March so Q1 to Q2 of next year, we were going to have no inflation. I want to say no, but normal, that 2 to 3% range.
And would you anticipate if we get there that the Fed, which is now aggressively raising rates, might then start dropping rates?
They operate backwards, right? So they are only looking backwards. So by that metric, by Q3 of next year, they would start dropping the rates.
Given everything you've said, and you've talked about the supply, like if you're rehabbing a house, materials, appliances, things like that were taking a lot longer and costing a lot more. What about construction and construction materials, wood, steel, copper, those types of things? Where does all that fit into the scenario that you're painting for us?
I will tell you specifically on copper and wood as well, but on copper, one project that I've been doing is for a copper distributor. And another one for aluminum. They do the lining for aluminum cans. But copper distributor in Chicago, they have a budget. They bring one container per month into the Chicago area into 3 milling plants. Their inventory dwindled to such a level that we began air freighting a container's worth every week. So they went from a prime example, right? What was a $3,500 per week. So that's $14,000 a month. We'll just call that $180,000, $200,000 a year. They were paying us $200,000 a week. That's massive. So from $200,000 a week to, what's that, $2.4 million per year on raw copper coils. So that's the type of, that goes into the middle of these cords that we use. This is not fancy anything. It is a raw material. And so when you talk about inflation, that is an exact correlation to what you're speaking about for builders. And that was just to get their inventory to sell to the tubing and the wiring customers that are going to go to building homes, to building anything. Same thing for wood. They weren't air freighting, but they just completely ran out up in Europe because of a labor dispute and a lot of it out of South America. A lot of wood comes from Chile and Brazil because of labor problems tied to COVID. All of that's getting right-setted now, right? We're no longer air freighting copper. It's a bummer for me because the profits are going down, but they're now in a much better position. The inventories are right-setting. And so the builders have access to this and they're able to get their materials, and they're probably still going to have to pay because those costs are embedded in that material in the warehouse. But as they kind of flush through and it gets through the distribution channels, those costs will kind of work themselves out. Again, 6 to 9 months.
Do you think we'll get back to pre-COVID pricing at that point?
I do.
And what about in China, where they still have the no COVID policy or zero COVID policy and the factory shutdowns there? Is that still happening? And will that still have an effect on the supply chain?
It's still, from Shenzhen and Hong Kong, we're still having some, I would call it more of slowdowns. There's still some delays, still a lot of shipping though. There's still a lot of shipping out of China. There's still some hangups when you're shipping to China, actually. So exports to China are more of a challenge than shipping out of China. But the specific provinces of Shenzhen, there's a bridge there that takes a little bit longer because they're doing some testing, and there's a little bit of you got to get a permit. So that's a challenge. It's working.
Final thoughts and advice for real estate investors, given the context of everything you've just said. What do you say to a real estate investor today? Go, stop, wait?
Definitely don't stop, right? We're always going to have these black swan events. It's going to be something. But to your earlier point, a rising interest rate isn't a reason to stop. It's just be aware of what's happening. And from a global supply chain, I do have the pleasure of working in a global environment. It's a great opportunity to see what's going on all over the world, and things are moving. Even though in some cases it's a little bit slower or more expensive, but they're still moving and things are opening up. I think we can all see that. I'm 100% bullish. I'm actually bullish on a specific niche of real estate, but real estate transactions are taking place every single day. So I'm very much bullish.
What niche are you bullish on, and how can people find out more about you and get a hold of you?
Yes, so I am a multifamily investor. And so they can find out more about me. We have a white paper on why we like multifamily apartments, and they can download our white paper just to learn more about why. It's multifamilyadvice.com. That's multifamilyadvice.com. You can just go download that white paper and read about 7 reasons of tax benefits and cash flow and appreciation and how we manage that. And that's it. It's a free white paper.
Well, Jeff, thanks so much for coming on the show and sharing your expertise on the supply chain issues, what you're seeing in your day-to-day world, and then also the bold predictions that you shared as far as getting back to that pre-COVID pricing and its effects on interest rates and things like that, and what real estate investors should be taking into account as they move forward. It's been very interesting having this conversation with you. Thanks so much for having it with us.
Awesome. I really appreciate it.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.